What happens when two of the world's fastest growing economies suddenly turn from partners into rivals? That's exactly the question gripping Washington and New Delhi tonight. In a stunning escalation, the United States has slapped a massive 50% tariff on a wide range of Indian exports, everything from textiles and auto parts to pharmaceuticals and specialty steel. For everyday Americans, this could mean higher prices at stores. For India, it threatens to disrupt an export-driven economy that relies heavily on U.S. markets. And for the world, it signals a deeper rift between two nations that just a few years ago were being hailed as natural allies in the global order. This isn't just about trade. It's about strategy, geopolitics, and the shifting balance of power. Both countries have shared interests, countering China's rise, securing technology supply chains, and boosting defense ties. But this tariff move shows how quickly those interests can collide with domestic politics and economic nationalism. So the real question is, are we witnessing the start of a new, bitter trade war? Or is this a high-stakes negotiation tactic designed to push India back to the table? Let's break down what's happening, why it matters, and what could come next. The United States and India have long described their relationship as a strategic partnership. Over the past 2 decades, the two countries have signed defense agreements, expanded technology cooperation, and increased trade to record highs. India has become America's 9th largest trading partner, while the U.S. is India's top export destination. But behind the handshakes and joint statements, tensions have been simmering. This latest move, a sweeping 50% tariff on Indian exports, isn't coming out of nowhere. It follows months of disputes over digital taxes, market access for American tech and agriculture, and India's growing energy and defense ties with Russia. Washington sees New Delhi as drifting too far from the U.S. camp, especially at a time when the White House wants a united front to counter Beijing. India, on the other hand, insists on strategic autonomy. It doesn't want to be pressured into choosing sides. So why is this happening now? Several factors converge. Domestically, both governments face economic headwinds and political pressures. In the U.S., leaders are under fire for protecting American manufacturing jobs. In India, Prime Minister Narendra Modi must balance foreign partnerships with nationalist expectations. Add in rising global protectionism, and you get a volatile mix. This clash isn't just about tariffs. It's about trust, leverage, and the future direction of one of the world's most important bilateral relationships. The outcome will affect not just American consumers and Indian exporters, but also global supply chains, multinational companies, and even defense alliances. To really understand the stakes, let's look at the 5 key dimensions shaping this escalating trade rift. Number 1. The economic shockwaves. When the U.S. government slaps a 50% tariff on a major trading partner like India, the immediate impact isn't just felt in boardrooms or political offices. It lands squarely in the heart of both economies. For India, the United States is not just another market. It accounts for nearly 1/5 of India's exports, a figure that represents billions of dollars in annual revenue. The tariff strikes at critical sectors that have long been engines of India's economic growth: textiles, pharmaceuticals, automotive parts, and specialty steel. Many of these industries employ millions of people, particularly in small and medium-sized enterprises that rely heavily on international demand. A tariff of this magnitude doesn't simply reduce profit margins. It risks factory closures, layoffs, and the destabilization of entire supply chains. Take textiles, for example. India is one of the largest suppliers of cotton garments and fabrics to the U.S., with tariffs driving up costs by 50%. American importers will either have to pass the price increases on to consumers or look elsewhere for cheaper suppliers. That means shoppers in New York, Chicago, and Los Angeles could soon notice higher tags on clothing, bedding, and leather goods, everyday essentials that once came from Indian factories. The same is true for pharmaceuticals. India is a powerhouse in generic drugs, which keep healthcare affordable in the U.S. A sudden price hike on medicines could directly affect hospitals, pharmacies, and patients who depend on cost-effective treatments. Meanwhile, American businesses that rely on Indian imports also face tough choices. Retailers and manufacturers may scramble to shift supply chains to other countries like Vietnam, Bangladesh, or Mexico. But moving supply chains isn't like flipping a switch. It requires renegotiating contracts, building new logistics networks, and sometimes even retraining workers. That transition period will be painful, costly, and uncertain. On Wall Street, investors are already nervous. Higher tariffs increase production costs, create inflationary pressures, and inject volatility into stock markets. For Indian exporters, the loss of competitiveness in their most important market could weaken the rupee, rattle investor confidence, and slow GDP growth. At the household level, Indian workers may face job losses, while American families may feel the pinch in their wallets. In short, this is not a narrow policy shift. It's a shockwave that reverberates across both societies. It threatens the economic integration that has been built up over decades, forcing both nations to rethink how much they depend on one another. And in a global economy still recovering from pandemic disruptions and supply chain bottlenecks, the timing couldn't be worse. Number 20. Strategic trust on the line. Beyond the dollars and cents lies something far more fragile: trust. The U.S. India partnership has often been described as strategic, built on the idea that two democracies with shared concerns, especially about China's rise, could align their long-term goals. But trust in geopolitics is like glass: once cracked, it rarely looks the same again. By imposing tariffs this steep, Washington risks signaling to New Delhi that partnership comes with strings attached, or worse, that economic pressure is a tool of control rather than cooperation. For India, this is more than just a financial blow. It's a question of respect and sovereignty. For years, Indian leaders have carefully crafted a policy of strategic autonomy. This means India avoids fully siding with any one power, preferring to keep its options open across the US, Russia, Europe, and even China when necessary. The tariff move feels, to many in New Delhi, like Washington punishing India for refusing to choose sides. And in a culture where national pride runs deep, such pressure is often met with defiance, not compliance. Consider the context. Washington has been urging India to scale back purchases of Russian oil and weapons, while simultaneously pressing for deeper alignment in defense and technology. From India's perspective, the tariffs look less like an economic dispute and more like political leverage, a way of forcing concessions on unrelated strategic issues. That perception can erode goodwill built over decades. If India loses confidence in the reliability of U.S. partnership, it could start hedging more aggressively. That might mean accelerating trade talks with the European Union, strengthening ties with Southeast Asian neighbors, or even cautiously engaging with Beijing despite long-standing border tensions. Moscow, too, would welcome any opening to draw New Delhi closer, especially as Russia seeks partners beyond the West. For Washington, this poses a dilemma. The U.S. wants India firmly in its camp to balance China in the Indo-Pacific, but punitive tariffs risk pushing India in the opposite direction. And unlike smaller nations, India is not easily swayed. It is the world's fifth largest economy, with a population of 1.4 billion, and has leverage of its own. Trust, once undermined, has ripple effects beyond trade. Joint defense projects, technology sharing agreements, and diplomatic coordination could all suffer. Allies like Japan and Australia, who rely on strong U.S.-India ties for regional stability, may also start to worry. At its core, this isn't just a trade dispute. It's a test of whether two major democracies can manage disagreements without jeopardizing their long-term partnership. If trust breaks down now, rebuilding it may prove far harder than simply renegotiating tariffs. Number 30. Domestic politics driving policy. Trade wars rarely emerge in a vacuum. Behind every tariff decision are domestic political pressures that shape leaders' choices. In the United States, tariffs are more than an economic tool. They're a political weapon. For years, politicians across both parties have emphasized protecting American jobs, especially in manufacturing-heavy states like Pennsylvania, Michigan, and Ohio. These are regions where voters feel globalization hollowed out industries and shipped work overseas. By imposing a 50% tariff on Indian exports, the U.S. administration can project toughness on trade, signaling to voters that it is defending American workers against unfair competition. Election timing matters too. With another election cycle looming, Washington is hyper-aware of how trade policies play with its base. Tariffs make headlines, and headlines matter in campaigns. Leaders can claim they are standing up to foreign nations that don't play by American rules. Even if economists warn about inflation or higher consumer costs, the political optics often outweigh the longer-term concerns. On the other side, Prime Minister Narendra Modi faces his own political calculus. His government is rooted in nationalism, emphasizing India's sovereignty and global standing. Being seen as bending to U.S. pressure could be politically damaging at home. By taking a firm stand against tariffs, Modi strengthens his image as a leader who defends India's dignity on the world stage. In Indian politics, standing tall against foreign interference resonates deeply with voters, especially in a country with a long history of colonial exploitation. Domestic industries also exert influence. In the U.S., farmers, pharmaceutical companies, and tech firms all lobby the government to shape trade policy. In India, textile manufacturers, small exporters, and pharmaceutical firms pressure New Delhi to secure fair treatment abroad. Leaders are constantly balancing these domestic voices against broader geopolitical priorities. The result is that both governments are locked into political narratives that make compromise difficult. Neither side wants to appear weak, especially when national pride and electoral gains are on the line. Even if negotiators behind closed doors understand the economic risks of escalation, political leaders may double down publicly to satisfy their bases. This dynamic means the trade conflict isn't just about tariffs on paper. It's about leaders crafting stories for their citizens. Each side wants to tell its people, "We are strong, we are independent, and we won't back down." And in the process, the path toward pragmatic solutions becomes narrower, turning domestic politics into a driving force behind global tension. Number 4. In global ripple effects, the U.S.-India tariff clash is not confined to their borders. In today's interconnected world, when two of the largest economies collide, the shockwaves spread worldwide. Supply chains, markets, and even diplomatic alliances feel the tremors. One of the most immediate ripple effects is on global trade flows. Many American companies rely on India for affordable goods, from pharmaceuticals to textiles. With tariffs making Indian exports more expensive, these companies may pivot to alternative suppliers. Countries like Vietnam, Bangladesh, and Mexico could benefit as new hubs for production. This shift, however, is rarely smooth. Smaller economies might not have the infrastructure or capacity to immediately absorb the demand, leading to bottlenecks and higher global prices. Pharmaceuticals are a prime example. India is often called the pharmacy of the world, producing a vast share of generic drugs. If the U.S. reduces imports, not only does India lose revenue, but global healthcare costs could rise. Other nations depending on affordable Indian generics might also face shortages as producers reorient supply toward non-U.S. markets. The tariff rift also influences alliances. Washington has worked hard to build the Quad, a strategic grouping of the U.S., India, Japan, and Australia designed to counterbalance China in the Indo-Pacific. If India begins to question U.S. reliability, it could weaken the cohesion of this grouping. That would be welcome news for Beijing, which thrives when its rivals are divided. China could exploit the rift by offering India new trade opportunities, subtly driving a wedge between New Delhi and Washington. Meanwhile, Russia stands to gain too. As India looks for alternatives to U.S. markets, Moscow may deepen its economic engagement with New Delhi, especially in energy and defense. Europe might seize the moment as well, accelerating its trade talks with India to fill the vacuum left by U.S. restrictions. The result could be a significant reshaping of global trade patterns, with India diversifying away from overdependence on one partner. On the financial side, global investors dislike uncertainty. Tariff wars between two giants increase volatility in stock markets and commodities. Currency markets may react sharply, with the Indian rupee under pressure and safe haven assets like gold benefiting. In essence, this is not just a bilateral spat, it's a global event. Smaller nations may scramble to adapt, corporations may rethink strategies, and rivals like China may quietly celebrate. The ripple effects of this clash are already spreading, and the longer it lasts, the more disruptive they become to the broader world economy and the delicate balance of power in Asia. Number 50. The possibility of negotiation. Despite all the tension, tariffs do not always signal permanent hostility. History shows us that trade wars often end at the negotiating table. The key question here is whether the U.S. and India can find enough common ground to de-escalate before lasting damage is done. From Washington's perspective, the tariffs may be less about permanently cutting Indian access to U.S. markets and more about creating leverage. By hitting sensitive sectors, the U.S. signals to New Delhi, "We want concessions on digital trade, on agriculture, on defense procurement." For American negotiators, Tariffs become a bargaining chip. For India, the challenge is how to respond without appearing weak. Modi's government will likely frame any potential talks as a negotiation among equals, not as a response to pressure. If India can secure concessions of its own, perhaps expanded access for its IT services, visas for skilled workers, or favorable treatment for its exports in other sectors, it might claim victory even while reducing tensions. The precedent exists. Past disputes over H-1B visas, intellectual property rights, and market access for U.S. dairy products were eventually resolved, sometimes after years of standoff. Both sides know that while they may clash over specifics, their larger relationship is too important to sacrifice. Defense cooperation, energy security, and shared concerns about China make it unlikely either side truly wants a prolonged economic war. Still, the path to negotiation is complicated. Domestic politics on both sides reward toughness, not compromise. Washington doesn't want to appear as if it caved to Indian pressure, while New Delhi doesn't want to appear bullied. That means talks, if they happen, will likely be packaged as mutual agreements, rather than one side yielding to the other. A possible scenario could involve phased tariff reductions in exchange for specific commitments. For example, India might agree to adjust certain digital tax policies or expand market access for U.S. agricultural goods, while the U.S. scales back tariffs in stages. Such compromises would allow both governments to declare victory domestically while restoring economic normalcy. The risk, however, is that brinkmanship goes too far. If either side miscalculates, the dispute could spiral into a full-scale trade war with long-term consequences. That's why negotiation is not just possible, it's necessary. Cooler heads on both sides will recognize that the U.S. and India have far more to gain from cooperation than conflict. The question is how long it will take for political will to align with that reality. The United States and India find themselves at a crossroads. A 50% tariff is more than an economic penalty. It's a signal of distrust in a relationship once seen as pivotal for the 21st century. The fallout could ripple through global markets, diplomatic alliances, and the everyday lives of millions of people. Will this confrontation spiral into a prolonged trade war, or will cooler heads find a way to negotiate? For now, one thing is clear. The choices made in Washington and New Delhi in the coming months won't just shape bilateral ties. They could redefine the balance of power across the globe. And as the world watches, the stakes couldn't be higher.